This video covers some of the information about options, its specific details, the two main kinds of options, and a little deeper introduction to call options. What is an option? An option is a contract that entitles the holder to buy or sell a designated security at a certain point of time at a particular price. So the value of the option depends directly upon the underlying asset. If it was an option on a stock, the value of the option would depend upon how the actual stock price moved, and that would govern what the option is doing as well. The two most common types of options are calls and puts. So a call option and a put option, and it's just referred to as calls and puts. What is a call option? Think of it as calling something in. Okay. It gives the owner the right to buy a fixed number of shares of a particular stock at a fixed price, either before or at a fixed date. So there's some time period between which you can exercise this option, or you can go ahead and buy that particular stock. And that time period will guide people to understanding whether it's a European option or an American option. So a European call can only be exercised at a particular point in time on a specific, basically it's locking in the date at which you can exercise that call, versus an American call. An American call, you can exercise it any time up to and including the expiration date. So if you had this call option, you could exercise your right to buy how many of the shares you want to, locked in that call option contract, any time up to the expiration date. So let's say you believe that the stock price is up right now and it's going to drop next week, and you want to exercise your option somewhere in between the time when you bought the option and when the expiration date comes up. You could do that with an American call option, but you could not do that with a European call option. So call options are usually traded in units of 100 shares. How do we call an option? How do we name an option? What do we say when we're trying to explain what option we have? Let's say it's a November 20th American call on Mobil at $70. That's how you'd say it. And that gives you the right to buy 100 shares of Mobil at $70 each. What are some terminology and options? $70, that is called the exercise price or the strike price, the price at which you can exercise that option. No matter what the actual stock price is in the market, this option gives you the possibility to buy that Mobil stock at $70 each. The final date is also called the expiration date. Up to that point, you can exercise the option. The investor who issues the call is called the call writer. So the person writing the call option, or who's selling you that right, who's giving you that right to buy all these stocks, is called the call writer. Now, something important to note is that these options do not have any effect on the value of the underlying stock. Okay, their value is determined by the underlying stock, but exchanging call options goes on between two investors. So it is like a side bet on the actual price of the stock. So it does not actually affect the value of the stock itself. The value of the stock affects the value of the option, but the option does not affect the value of the stock because it's going on between two investors at the side in the market. Let's look at some profit profiles for holders and writers of call options. Okay, so the y-axis is representing profits, and the x-axis is representing stock price. So these are characteristic lines that always happen for a call option, whether you're a holder or a writer. Let's look at the holder situation. So you bought this figure shows a call option where you pay $5 per share to the call writer for the option to buy that share at $50. So that $5 is sometimes called a premium. You pay this money to the writer in order for the right to be able to buy the stock at $50. So the red areas are the part where you are making a loss as a holder. The green areas are where you're making a profit. If the stock price is below 50, if you're somewhere over here, let's say it's 45, you will not exercise the option and buy that stock at 50, because you can go to the market and buy it at 45 rather than 50. At that point, you've basically lost that $5 you've paid. You chose not to exercise the option and you let the option expire. And you still bought your stock at 45. That was a lower price in the market. Now, at between 50 and 55, right over here, you will exercise the option. Okay, because you're able to get back some of the money you paid to the writer in the first place. Let's say the prices in the market of that stock is now 54, right over here. So the price is 54. You've been able to buy the stock at 50. Okay, so you're making a $4 gain on that stock price now by exercising that option. However, you paid $5 to the call writer for the right to buy that stock at 50. Okay, so you've made a $4 gain, but you paid $5 at the beginning to be able to buy that option. So your overall is still a loss. You've made a loss of $1. But between 50 and 55, you're able to get back some of that amount that you paid in the first place. So you will exercise the option anytime you cross this $50 mark. Above 55, however, above 55, you will be making a full profit. Okay, because you can buy the stock. Let's say it's 56. You can exercise that stock at 50. You can exercise that option at 50. Buy the stock for $50. Sell it in the market for $56. You've paid $5 to the call option writer, and you're still left with $1 extra. So you've made a $1 profit overall. Now let's look at the trend line for a call writer. Okay, for a call writer, basically this curve is flipped over. Okay, it's exactly the mirror image across the x-axis. If the price is anything less than $55, the call option writer makes a profit. Anything greater than $55, the call option writer makes a loss. So let's think about it in that sense again, as having a price of 45 maybe. If the price is $45 for the stock after the option expiration date has been reached, the holder chooses not to exercise the option. They've already paid you that $5. They do not exercise the option to buy it at 50. You've made a full $5 profit per share. Now, if the stock price goes between 50 and 55, the holder is going to exercise that option. Let's say it's again at 54. The holder will exercise the option and buy that stock from you at $50 instead of the market price of 54, but you already got $5 from them. Okay? And now you're losing $4 in that transaction, but you still made a profit of $1. Once the stock price goes above 55, the call option holder is going to exercise it at 50, and then you're making a loss because let's say it's at 56. If they exercise the option at 50, you've only gotten $5 from them, but you're losing $6 in the process of the exercising of that option. So now you've lost $1 on the overall. So those are the three characteristics written here. Below 50, the writer makes a profit of $5 per share. Between 50 and 55, some of that $5 that you made is now given back to the holder. And above $55, the writer makes a loss. So now what options does the holder have in addition to choosing whether to exercise the option or not? Okay, there's a third sort of choice that the holder can make once they hold that option, which is to sell their option on the exchange. And later we're going to show that selling the option on the exchange for an American option might actually make sense. So in the next video, we'll go to put options and talk about some of their characteristics as we just did for call options.